Hi everyone! Let me give you the macroeconomic pictures as we see it going forward for 2017, and then Ricardo will give you our investment positioning. So, since our last meeting in September, we had Trump's election in the United States, which triggered somewhat of a surprising reactions in financial markets. We had some tensions in the bond markets, and we'll see whether there's some fundamental reasons for this. Indeed, what we can expect for 2017 is a pretty good macroeconomic picture. We have rock-solid growth in the US, and indeed this growth might be even strengthened through Trump's reflationary policies. The whole plan to boost infrastructure spending will clearly accelerate US economic growth. Indeed, we can make a comparison between what Trump is planning to do and what Reagan did in the 80s. So we talk about Trumponomics. And as you can see from this chart, the idea is to reduce the tax rate. And that will for sure increase growth. But possibly, and this is the core idea of Trumponomics or supply-side economics, possibly we could even have such a boost to economic growth that indeed, in the end, you actually increase tax revenues. So that's the fabulous idea. It looks very nice on paper. We'll see whether it works in practice. It did not work with Reagan, but we'll see whether it worked with Trump. But indeed, what we can say is that the US growth is rock solid for now, and it might be even stronger in 2017. We can see this from the chart showing US consumption, and our favorite indicator for what remains the driver of the US economy, consumption, is to look at consumer confidence. And we see that the consumer confidence is anchored in double-digit growth, so pretty far for our trigger for a recession risk at minus 20%. Elsewhere, we have still lackluster growth in the Eurozone, and so we're expecting more actions from the European Central Bank. We have some improvements in emerging markets. We have a rebound of economic activity in China, boosted by double-digit growth in investments in the SOEs, in the state-owned enterprises. Also some improvements in Brazil and Russia. So all in all, we have a pretty good macroeconomic growth that we can expect in 2017. And this is a long-term positive thing for equities over bonds. And this is shown by this chart here. You see the GDP growth remains solidly anchored around 3%. And we have the equities versus bonds performance showing no excess of the former on the latter. But there is a but. This strong economic growth is likely to generate inflationary pressures. And indeed, we can see already these expectations on the rise in the US, a bit everywhere. In the US, in the Eurozone, we have a strong rise in producer prices in China. So this, and we saw the reaction from the Fed, it was widely expected this week, it rose interest rates. So we expect more to come on the side, and indeed we could see some more tensions on bond yields. And this is a risk we monitor very closely here at Novastone, because we believe that if there is one danger for equity markets, for risky assets, is at some point the nice story, you know, the TINA, which we gave you in the last video, there is no alternative. All these investors that have come into risky assets because there's no alternative, because they're hunting for yield. So that story could come abruptly to an end if there is some uptick in bond yields, and at some point bonds become more attractive relative to equities. Well, talking about that, now is a good time to give the word to Ricardo, who will tell you about our tactical asset allocation.
Thank you, Michel, for the macro picture. It seems like 2016 was never going to end. It was full of surprises, and it was indeed an uncertain year for markets and in terms of political events. Indeed, since Trump's election, markets have been positioning for a reflationary environment. And at Novastone, we have been doing some changes in our portfolios. We have been adding to riskier assets, a small portion in emerging market corporates, hard currency, and also we added a small position on senior floating rate notes that have the benefit of almost no sensitivity to raising rates. And we are higher in the capital structure, and we also keep a good carry of, say, 4.5% to 5%. On this side, on the investment side, we have also been adding to some European banks. After the Italian referendum, we saw it was a good timing to enter into the sub-asset class. From now until the next meeting, we will be looking to reduce our underweight in US equities, and we will do this by investing in a value-oriented manager that has a tilt towards small mid-cap companies. And as we discussed during the board, the small mid-sized companies are the ones that are going to benefit from Trump's policies. Although there's high uncertainty on what he will do or he won't do, but that's our view. 2017 will be a year full of challenges, but as you know, with challenges come opportunities. Please, any question or feedback, write us an email on the address shown below. And at Novastone Capital, we'd like to thank you for the trust that you put in us, and we want to wish you all the best for 2017.